let's get real about inflation. I think it's time we have a talk about this, because it seems like it's the number one concern we're hearing from many of our clients, and we're seeing it on the news quite a bit, and there's a good reason. Consumer prices soared 7% in December, marking the largest yearly increase since 1982. Now, this was reported by the Labor Department last week. Now, the biggest culprits, shelter costs, things like rent, and used car prices. Now, shelter costs, they jumped 0.4% in December from the previous month, and a total of 4.1% for the year, which is their fastest annual growth rate since February of 2007. Now, used vehicles, well, they've become, I guess, the poster child, if you will, for the current inflationary environment. They've increased 37% over the past year. So if you got a car to sell, good time to do so. Gasoline prices, they've also spiked nearly 50% since December 2020. Though fuel and energy costs, last month they dipped a little bit. Now, while many Americans have gotten a raise this past year, the pay bumps, they haven't kept up with price bumps or the cost of living. The real average hourly earnings or wages take into account inflation. They fell seasonally adjusted 2.4% in December from a year earlier. In other words, you're making more money, but it's going not as far. So what can be done? Well, let's start with the Fed, whose literal job it is to keep prices under control. Obviously, they've been caught flat-footed as inflation spread across the economy pretty rapidly. Now, the central bank is now planning to wind down its stimulus measures and hike interest rates several times this year. I think they said about 3 times is what is expected. Now, the point is that higher interest rates increase borrowing costs for both consumers and also businesses. Now, in turn, this slows down demand, which incentivizes more saving and deflates prices. Now, what about other ideas to solve the problem? Well, the Biden administration has recently launched what we call an antitrust crusade against highly concentrated industries with the hopes of more competition bringing down prices. And the U.S. Chamber of Commerce argued for more immigration to ease labor shortages. So those are 2 things that are being batted around right now. But here's the thing. Some analysts, they argue that the only fix is to simply wait it out. And that's because the COVID-related supply chain bottlenecks that helped fuel inflation, well, they're still here. They're still raging. And prices will only start to cool down when constrained supply simply catches up with demand. So what's the big picture? I think that's the important question. Those bottlenecks, they're probably going to get even worse. Manufacturing powerhouse China, well, they've locked down roughly 20 million people across 3 cities in an attempt to prevent widespread Omicron outbreaks. Now, HSBC economists warned that Omicron gaining even more steam in Asia, where it hasn't really taken off to a full level yet, could lead to the mother of all supply chain disruptions by forcing factories to close down or just go offline again like we saw in 2020. In other words, we're not in the clear yet, and we probably won't be for some time. Now, if you've got questions about how this impacts your investments, your portfolio, or your financial plan, please feel free to give us a call at 704-553-0123. We're always here to talk and to give you some good guidance about what's going on in the economy and how it impacts your financial plan.